Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity Podcast. It is August 1st, 2017, and I am your host, Chris Martenson. Now, I've often said that you really need to keep a journal because you are living through financial and economic history. Never before has money printing been tried on such a grand global scale. Never before has the United States been swept by sequential financial bubbles, the lessons of the last ones forgotten in what appears to be record time. But perhaps the most astonishing modern fact concerns the current interest rates seen around the world, ranging from record-breaking lows, as in the case of junk bonds in Europe today, to effectively zero rates in Japan for a long time, or even negative rates all across the Europe sovereign structure. We really have to stretch back deeply through historical time to even begin to appreciate what we're experiencing. So to help us do that today is Richard Sylla, Professor Emeritus of Economics and the former Henry Kaufman Professor of the History of Financial Institutions and Markets at New York University Stern School of Business. He teaches courses in financial history, economic and business history of the United States, and comparative enterprise systems. His primary areas of research, though, include historical studies of money, banking, and finance. He's the author of several books, including The American Capital Market and the book that draws him to our program today, A History of Interest Rates. Prior to joining Stern, Professor Sylla taught at North Carolina State and the University of Pennsylvania, among others. He received his Bachelor of Arts from Harvard University before studying at the Indian Statistical Institute at Calcutta. He then received both his Master of Arts and his Doctorate of Philosophy from Harvard University. Welcome, Professor Sylla.
Oh, good morning, Chris. Glad to be with you today.
So let's set the stage right here. Why are interest rates important to study? What can they really tell us besides the cost of money?
Well, I think interest rates are the interest rate in economic theory is one of the key prices in the economy. It's sort of the rate at which we exchange the present for the future or the future for the present. So much of life is about let's put it in simple terms. A person who wants to take out a home mortgage when they're young, they don't have enough money to buy a house, and the interest rate is what they have to pay to transfer money from the future to the present so they can buy a house. A little closer to home for me is that I'm retired now. You mentioned I was Professor Emeritus, and so over the course of my career, I had to save up money and transfer it from the present to the future, so the future being now when I'm retired. And, obviously that the interest rate, the rate of exchange between the present and the future was very important to me. And, the lower the interest rate, the more you have to save to have a comfortable retirement. So it's one of the key prices in the whole economic system.
Well, let's talk about that for a second, because one rule of history seems to have been that savers deserve to be compensated for lending their savings across time, as you're putting it here. Governments have aggressively rewritten that rule and determined, as far as I can tell, for what appears to be maybe the first time in 5,000 years of history that savers deserve nothing. I don't even know how to phrase the question. Perhaps what could possibly go wrong, or how do we interpret this?
Well, it's true that the rates we've had in recent years, including just about right now, are the lowest in history. The history of interest rates, the book that I co-authored on this, kind of traces the history back to, the Code of Hammurabi, if not earlier, through Babylonian civilization, Greek and Roman civilization, the Middle Ages and Renaissance, early modern history, right up to the present. And I can assure our listeners that the rates that they're experiencing right now are the lowest in human history, according to all the records that we have.
The lowest in human history.
Right.
No, do we have any periods with negative interest rates, for instance?
I think they're very rare. One previous period was the late 1930s when, some scholars unearthed the fact that there appeared to be negative interest rates on U.S. Treasury bills around like 1939, 40, 41. But it turns out that that may have been a figment because if you had a Treasury bill, that gave you certain rights about exchanging it for another one, and that right had a little value, an option value, you might say. So what appeared to be a negative interest rate wasn't really a negative interest rate. It had to do with, tax issues and things like that. So I don't think we've had negative interest rates before.
So nothing like, say, the Swiss National Bank charging negative 0.75 of a percentage point for any reserves held with it. Nothing like that in the history books.
No, I don't think so. I mean, they were actually targeting. They wanted to have negative interest rates now, and because the Swiss case you mentioned is a prime example. I should say that there were de facto or after the fact negative interest rates when you had great inflations in wartime, and the interest rate didn't adjust, and so there were periods of high inflation that people did not expect when it turns out they were getting a negative interest rate. But, what's really unique about the current period is that the negative interest rates have been a sort of policy target, not some accident of a high rate of inflation during a war, but a policy target of central banks that wanted to install a negative interest rate for some purpose.
Well, now let's talk about that because, part of my concern is that when you look at the composition, say, of the Federal Open Market Committee at the Federal Reserve, and you look at the backgrounds of the people who are on there. We've got some academics, we've got some people, a lot of economists, we've got a lot of people with legal degrees, law degrees sitting there. Of course, the bank presidents who sit on the non-voting part in the regional banks coming up through other means, often, right up through the system. But the FOMC itself, I look at them, Professor Sylla, I don't see anybody on there who's got a really deep historical background, such as you have. I don't see anybody on there who understands sociology, because I think a negative interest rate is as much a sociological experiment as a monetary one. What do you think is there? What are they going on there or at the ECB when they've decided to wade into deeply negative rates in real terms, even negative in nominal terms? What are they relying on in terms of formulas, theories, ideas, do you think?
Well, I think they, I disagree with you a little bit. I think the members of some members of the Federal Open Market Committee and some of the European bankers, they do know a little bit of history. I mean, and I think Ben Bernanke, I can assure you he's not there anymore at the head of the Fed, but he actually knew a lot of the history of the 1930s. And what I would say about them, it's not that they're ignorant of history, but they only go back to the 1930s, and it's that the Great Depression, was a period when the bottom fell out of the economy, and people have studied interest rate history then, and that felt that the Fed kept money too tight. And so I would say that the part of history that almost all central bankers know today is the history of the 1930s. There was a big deflation, which meant that real interest rates were actually high, even if nominal interest rates seemed low. And so they remember that history, and I would say today's central bankers base a lot of their thinking on let's avoid another Great Depression, and that's to avoid another Great Depression after the financial crisis of 2007, 2009. They decided that the way to do it was not to allow deflation to take place, so they pumped in all this money. And the Federal Reserve balance sheet is quintupled in size in just less than a decade, and I think so they do base some of their thinking on history, and I think they overemphasize it, but they think that deflation is just the worst thing that can happen, and therefore we have to pump money out to avoid any chance of deflation. So that's what we've basically done with our monetary policy for the last decade or so.
So if we could back out just a second, though, when we forget about money as this thing we work hard for, it's an agreement, it's a social contract, and we've never had a social contract which has been written in this way. So one of the views I hold, and this might be unfair, is that the Federal Reserve is not a wealth-generating institution, but they are a wealth redistributing institution, something I've been long on record for. First put out a piece of work in 2008 saying that this money printing experiment that I saw coming was going to create a pretty ferocious gap between the rich and the poor. mostly due to an uneven balance of financial asset holdings. That's largely proven true. Is it not true that these policies of the central banks are really, in effect, picking winners and losers?
I think so, and that's one of the criticisms that it was leveled early in the financial crisis, or when we were coming out of it. That one thing the Fed did, it used to trade only in U.S. government debt, and buying and selling Treasury. Even at times back in the 1950s, they dealt in only short-term U.S. government debt, like Treasury bills. In the more modern recent decades, they've traded in long-term government bonds and short-term Treasury bills and intermediate securities. But what happened in the financial crisis is that they did in fact buy up a lot of U.S. government debt. Then they began to buy mortgage-backed debt, and then the housing was, of course, one of the main problems in the financial crisis. And what that did was the Federal Reserve, went on record as saying the housing is something special. So we're going to support the housing market, and that's redistribution in a way, because a lot of people live in apartments and don't benefit from very low mortgage interest rates. So I would say that one prime example of the Federal Reserve's redistribution policy was to favor housing. And of course, you mentioned, Chris, that the low interest rates had effect on other asset prices, and certainly we've seen a great bull market in stocks ever since 2009. I've been surprised by the extent of it myself. I mean, I did believe that we would have a recovery, because it turned out that stocks really dropped a lot during the financial crisis. And usually when returns get to be as low as they were around 2009, 2010, the next decade, I've studied asset prices throughout U.S. history, when returns get to be so low as they were in 2009, 10, the next decade's usually better. Well, the next decade has been better, but it's gone a little bit beyond what I thought it would do.
Well, you and me both, and we did have a very interesting beginning of what looked like a rollover in the markets in 2016 early. And since then, it should be noted, it's not just the Federal Reserve, but we have to look at the big three, which is Bank of Japan, European Central Bank, Federal Reserve. And we could toss in Bank of England, Canada stuff if we want. But the G3, those three I just mentioned, their balance sheet expansion has never been faster in all of history since that point of time. In fact, in the first 5 months of 2017, $1.5 trillion of balance sheet expansion, which is, of course, the central bankers are saying we need to keep the financial markets roaring. And this is where I want to get back to. Is that not potentially overlooking one of the lessons from, say, the 1920s?
You mean causing too big an asset boom as in the 1920s stock market? And there were also housing markets in the 1920s that were booming and bubbling. I think that's part of their that's part of what's been going on. I mean, they have caused stock prices to rise a lot, and it doesn't seem that house prices in general everywhere in the country are soaring, but there's certain markets in the U.S. And in Canada, I guess the whole country's had a housing boom, bordering on a bubble. But in the U.S., certain areas, in San Francisco and New York and Florida and Texas, I guess, have been experiencing rising prices. Some say it's because foreign money is coming in. Russian oligarchs and Chinese billionaires are buying housing in the U.S. But I also think that it's being underpinned by this low to negative interest rate policy.
Yeah, certainly a strong case to be made for that. You mentioned San Francisco. There, the Board of Supervisors recently announced that to qualify for government assistance in housing there now, you can have a combined household income of $138,000, which is well above the median income. So they've already sort of thrown in the towel and said, something way beyond median income is still not enough.
Yeah, I understand that, couples, two-income earner couples in San Francisco are not making enough money to be able to afford to buy a house in San Francisco, so they're moving out farther and farther into the suburbs. Or I think I saw an article recently that some companies are transferring their operations to places like Denver from San Francisco, and because the people that work for them may be paid pretty well, but they can't afford housing in San Francisco. They might be able to in Denver.
Right. That's pretty far to go. That's quite the commute. So listen. Clearly, there's a case to be made that there's some unnatural influence on the price of money at this point in time, with central banks very aggressively pursuing a set of policies designed to drive the rate of the price of money, the rate of interest down. No surprise, no controversy there. But are there what we might call benign reasons for interest rates to drop at this point in time? Is it possible that what role does globalization or increasing technology, things like that, what roles do those play historically?
Well, they're always a factor, and I think they're a factor now. And I've been kind of wondering why. Paul Krugman of the New York Times writes an article about once a month saying that people thought that these central bank policies would unleash a terrible inflation, and they've been saying that ever since the financial crisis. One of the great puzzles is why we haven't seen more, what should we say, consumer price, wholesale price inflation. In fact, the Federal Reserve in the United States claims that inflation isn't high enough. It's only 1.5%, and it ought to be 2%. So I guess one of the puzzles for us economists is that why haven't these money printing policies caused more inflation, except possibly in asset prices rather than consumer prices? And I think that might have to do with the nature of modern technology. I'm an economic historian, and in the 19th century we built a lot of railroads, and in the early 20th century we built a lot of electrical utility infrastructure, built highways, and all those took a lot of capital. And those were the sort of leading industries of that era, a century or more ago. What I see in the modern world is, what are the cutting edge technologies today? Well, there are things like Facebook and Uber and Apple. And Apple iPhones are wonderful things, but they don't take a lot of capital, let's say. They take a lot of human ingenuity. And Uber, the classic case of Uber, it's a company that doesn't really have to have much capital. The drivers of the cars buy their cars, which they might buy anyway. But Uber itself doesn't really have to have a huge amount of investment. Facebook is another one. So what we call the cutting edge technologies of today don't seem to require much capital, and compared to previous technologies, so like building highways, building electrical infrastructure, building railroads. And so maybe the demand for capital isn't so great today, so you combine that with central bank policies that keep interest rates very low, and there's just sort of what Ben Bernanke called the surfeit of savings in the world, and that's bringing about our low interest rates. But I think this deserves more study. It's one of the the puzzles that economists haven't actually explained yet.
Yeah, surfeit of savings, I've only sort of half cottoned onto that as a concept. I'm also a big fan of the idea that when the Central Bank of Europe, for instance, throws in nearly 4 trillion euros over a decade, and even is involved in purchasing corporate bonds through private placements, ones that haven't even hit the market yet. That's a form of capital or liquidity that also has to be accounted for in the story that goes well beyond savings. It certainly seems like there's finding money out there when a central bank has just printed a 1.5 trillion in 5 months. It's not hard. Of course, the cost of money then comes down, which is the central bank policy in this regard. Right.
But we have to ask ourselves, why isn't all this, there are many cases in history where money printing led to a large amount of inflation, and we haven't really seen that in consumer prices, although we may be seeing it in the bond market itself. Very low interest rates mean very high bond prices, and also the low interest rates seem to be propping up the stock market.
Oh, I can name 3 other markets right off the top of my head. One is fine art. Another would be rare gems. A third would be Gulfstream 5s and 6s. All very expensive right now.
Right. Well, collectibles. You're talking about collectibles, right? These are sort of old assets that are around that are rising a lot in price. But, if you go to the grocery store, prices may seem up a little bit, but in general, they haven't had a huge amount of inflation in the last 10 years.
Well, I'll connect 2 dots in that. What I was saying really was that because of the way the money was dumped in the markets, it preferentially went to a very small cadre of people. We'll call them the rich for the moment. The rich then took all of this money, spent it on the things they care about. Well, we saw inflation there. So trophy properties, diamonds, fine art, things like that, and Gulfstreams, lots of inflation there. Just track the prices. But the money hasn't made it to Main Street. And again, now we're back to sort of this sense of winners and losers in this story. Talking with people in Main Street, I find there's a lot of distress there. I think it starts to explain things like Brexit, rising political social tensions. You saw the G20 protests maybe in Hamburg, or you see the Trump electorate. These are, I think, average people, we'll call them Main Street for the moment, saying, this isn't helping us. That's part of...
So I kind of agree with you on that. There, large parts of the population haven't seemed to have gotten much benefit at all from these central bank policies or even the recovery, but the rich have done quite well. Of course, they're sort of competing with each other to pay, $100 million for a picture or painting or something like that. But yeah, I mean, that's what we're seeing today. There may be, I think the low interest rates aren't just affecting the asset prices, though. I mean, in a sense, there's this search for yield that was going on before the financial crisis, and it's something we probably ought to worry about because, money may be being misallocated now in the sense of the one area that I see is that despite low oil prices, apparently the Wall Street capital markets are feeding a lot of money into oil exploration in the United States. And many people say that, this is not a wise allocation of capital because a lot of these shale oil company, oil and gas drillers are not really making any money now. So Wall Street is putting money into a business that doesn't seem to be where the returns don't look to be that great. And this suggests to me that the low interest rates are possibly misallocating some of our capital.
Oh, absolutely. The junk bond prices at this point, U.S. and Europe, clearly say that this is one of the first times in the history of those bonds I can find where once you factor in inflation and risk and other things, that people are accepting the equivalent of a negative yield on junk bonds. It's an astonishing. It's never happened before in my data series. So look at that and I go, well, that's odd.
Yeah, and it suggests that we're misallocating capital because let's suppose that a lot of these junk bonds fail, as they tend to do sometimes, or the shale oil drillers go bankrupt after Wall Street put a lot of money in there. That means that we're misallocating capital, and I think that's really one of the worries about very low interest rates such as we're having now, that it does cause distortions and misallocations.
Oh, absolutely. And in the shale drillers, I will note that among the top shale drillers, they're holding collectively around $350 billion in debt right now. And this not on the equity side, just debt. And so if you say, well, okay, round a few things, wave your thumbs, they're getting maybe $35 a barrel at the wellhead. That means under current pricing and current debt, the next 10 billion barrels produced have to go to just service that, just to pay the debt down. Doesn't include the interest cost. It's an astonishing number when you compare it against their actual known reserves. You say, wait a minute, this whole thing doesn't make sense. That feels like it could be a misallocation of capital, possibly.
Yeah, it's not only astonishing, it's a bit scary, I would say.
But we've been here before, and so one of the things that I was a critic of Greenspan, a critic I've been a critic of all the Federal Reserve chairmen because I don't believe in their central thesis, which is that they are responsible for managing the boom and the bust cycles, that they can take pride in the great moderation, that they've somehow figured out how to fine-tune and micro-manage us away from having a business cycle. Historically speaking, business cycles. Let's talk about those. They feel pretty routine and regular. Why do they happen, and have we managed to somehow escape them?
Well, the old idea of the business cycle was that, that's when, as I mentioned earlier, when you had utility investment, highway investment, railroad investment, then the economy you would sort of overinvest for a few years, and then people would say, oh, well, maybe the returns aren't there, and then you have a depression. And those business cycles were, 3, 4, 5 years. Starting in the 1960s, we had a very long expansion, then we had another long expansion in the 1980s and a long one in the 1990s, one not quite so long from 2001 to 2007. So it seems to be true. The Great Moderation, of course, applied to that 1980s and 1990s, which led people to think, well, the economy's more stable, therefore we can take more risk. Well, that came to a bad end in the financial crisis of 2007, 2009. I think that, the business cycle doesn't seem to be what it used to be, and I would relate it to the fact that it's not so much tied to heavy capital investment in certain areas. As I mentioned, Facebook doesn't really require that much capital, and Uber doesn't require that much capital. So maybe the economy is a little more stable now, but that doesn't mean that Well, I hearken back to Hyman Minsky. I knew Hyman Minsky. Minsky sort of said stability breeds instability, and I think we found that out in the financial crisis of 2007-09. And I see that now, they talk about the VIX being very low on the stock exchange. People don't seem to think there's much danger out there in the world. And if Minsky is right, this attitude that things seem to be very stable now, therefore I can run out and buy stocks at prices that are historic highs, that may be setting us up for the next financial problem.
Might be, or would you go further than and say is?
Well, you want to be a little cautious, but I say there are a lot of similarities to what's going on right now in what went on before the 2007-09 financial crisis, and people don't seem to worry about that. It's like, things are really stable now, and the central banks got us through the crisis without having a Great Depression, so we won't have that. I mean, there's probably too much optimism right now about the economic future.
Well, with the VIX actually hitting all-time lows, or at least 50-year lows recently on a closing basis, that's pretty historic low volatility. And of course, when you look across the political and then the geopolitical landscape, you could make a case that there might be some sources of risk out there.
I think so. I mean, I studied the political world a lot, and it seems to me the political world is in quite a bit of turmoil. The U.S. and Russia seem to be at loggerheads now. The Trump administration seems to have a lot of trouble getting any traction. There are a lot of China-U.S. relations are not great. There's the North Korea-South Korea problem. I mean, I see a lot of geopolitical risk out there, and our financial markets don't seem to be paying much attention to it.
That's interesting, and part of the thesis I've been running with is that these aren't my dad's financial markets, not my granddad's, certainly not even mine. Starting in 2008, the rise of the machines, with so much of the volume and the quotes I think 99% now are delivered by algorithms and high-frequency trading programs, and the total volume of the markets, 50 to 70% algorithms. This means that there's a lot less human intervention. So again, is this a technology shift? Is there some sea change in how markets operate that needs to be understood better?
Well, we have artificial intelligence, and I think, as you say, algorithmic trading is popular now, high-frequency trading, and the volumes are fantastic. I first started studying the stock market or participating in it in the 1960s when I was working on my PhD. And then, 10 million shares was a pretty big day in the stock market. Now, I think they do 10 million shares in the first few minutes every day. So we are living in a different world where there's a lot more trading going on, and the trading volumes are very high, and people are watching their screens all the time and pressing buttons, and so it definitely is a different world, and of course that can get us into trouble. We had the flash crash, which was a brief period of market drop there a few years ago, and of course the crisis itself showed that you can't always get out of your position, even though you think it's liquid. You can't get out of your position at a price that is anywhere near what you thought you could.
All right. Well, Professor Sylla, I'd like to turn now to an idea that peak prosperity, we study resources a lot, and we think that two E's need to be combined. One is economics, and the second is energy, particularly. Right. So as you look back through history, I'm wondering about if you came across or studied what happens with respect to financial markets, interest rates, if or when nations underwent either a rise or fall in the relative resource constraints or abundances that they might have encountered.
Well, I think that U.S. history is a pretty good example. We've uncovered a lot of resources in U.S. history. That's where we've been innovative in extracting metals from the ground and finding oil. The oil industry began in the United States, and a lot of mining took place in the United States. So we actually used our resources a lot, and that was a source of our prosperity. I would say whenever there were resource discoveries, you tended to get booms. Like the classic one that most people know about is the California gold rush, when the gold was discovered there. All kinds of resources rushed into California, and the gold miners didn't make all that much money, but the people who supplied them with supplies at high prices made a good money. And so I think resources, when you discover them, they do lead to booms, and then the booms usually produce busts. The oil industry is another example. There used to be a lot of wildcat drillers in the 1870s and 80s, and a lot of them went bankrupt, and at the end of it all, Standard Oil under Rockefeller seemed to control a large part of the industry. There's going to be winners and losers in these booms too, and I think that may be going on now. I mean, we talked earlier about who's winning and who's losing today, and I think we see some examples of that.
Well, there's an increasing chorus of people out there saying really heretical things like infinite growth is not possible on a finite planet. A lot of economics seems to predicate itself on continuous compounding growth. Of course, anything growing by some percentage over time is compounding. So the idea that we have a compounding system of money, it feels to me from where I'm looking when I really track resources, what's going on. You mentioned a lot of geopolitical hotspots. They make more sense to me when I flip on my resource lenses. So if you understand what resources exist in the South China Sea, the Senkaku Island sort of tensions that are happening make more sense. Like China needs access. They understand the resources issue very well. Their behavior in Venezuela belies their actual true intention, which is to secure access to oil resources going forward. Always has been the case. But when you look at what's happening with shale drilling and the tar sands, those are technologically gifted genius. I know people in the business. It's amazing what they're doing. And yet, if you step back, I can't help getting the impression that we're scraping the bottom of the barrel. So cast forward 10, 20, 30 years, which is a normal sort of projection horizon for a company making a large capital decision, but it should be for our country as well. When I do that, I say, wow, resources are no longer going to be there as an assumable input. Like you can just ignore those, we'll run our economic models, the resources will show up if the price is right. I don't think that's true anymore, and I'm wondering about your thoughts on that sort of line of thinking.
Well, I think it could be true in the United States, but I assume that we're in the forefront of developments like shale oil and gas production, and there's probably a lot of places in the world where these resources are not being tapped nearly as much as they are in the United States. So in the United States, especially if going back to our earlier discussion, if we're putting too much of our capital into getting shale oil and gas out of the ground now, well, that means we might really want to save some of that for the future. I don't really think the world is in danger of running out of these resources quite so soon, but the United States could, by overexploiting the resources now, run into the problems, as you say, in 10, 20, 30 years from now. And that won't be bad as long as we have a peaceful world, but if you combine that with all these geopolitical tensions, maybe we would be in trouble. We'd go back to when we had to import great amounts of oil, and it seemed like we were at the mercy of the OPEC states back in the 1970s and 80s. That could come back to us. We're feeling pretty good about our near energy independence now, but I think you're right that 10, 20, 30 years from now, we might be back to where we were in the 1970s and 80s and have to rely on the goodwill of others to keep our energy available.
Well, even still, that idea of energy independence, let me just frame that for a second. It's been put out there a lot. I don't care about energy independence, meaning if we add up all the collective BTUs from coal, natural gas, oil, and put them in a pot and say, oh, look, we're meeting most of our BTU needs. Let's look at oil, because that's really the lifeblood of any economy. We still import 5 million barrels a day. That's about how many are currently coming out of shale after one of the largest potential misallocation of capital. But it's been a real frenzy of output. We would have to double that output from its current state. Very hard to do if you understand the dynamics of depletion in that business. Long story made endless. I think we're just going to be net oil importers for the rest of time. I don't see any way around that given the data we have. So that's the world we're in right now, and so that means we don't really have energy independence from an oil standpoint. I don't know how we get there. So when I look forward on this, I don't think we're running out of fossil fuels. But when you look at the total shale basins in the world, what other people could do, it looks like the world peaks in fossil output around 2030. I'm off by a decade, it's 2040. Off by another decade, 2050. Who cares? I'm willing to concede this is very hard to predict. But at some point, those level out and then start really going down. Now, one of the most durable statistics I have in all of economics is energy consumption against real GDP growth. It's almost a straight line. The correlation's very, very high. It's beautiful. So when I look at that, the conclusion is, hey, if we're going to have more economy, we're going to be using more energy. This is where I see one of the greatest missteps that's being made right now, which is the amount of capital, Professor, that's going to be required to transition away from fossil fuels towards something else is going to be the largest output of capital in human history, given the scale involved. How do we? The question is, are people in your profession talking about this yet? Is this being understood, or has the resource side really not snuck in yet?
Well, I think economic historians have probably studied this as much as anyone, and any group of scholars. And there were transitions in the past. Wind and sails were the source of energy in a kind of early modern history, and then we discovered steam engines that you could run on coal, and so we mechanized that and generated power. I remember we used to, in the United States, if you ever read Moby Dick, we had our houses lit at night by whale oil lamps, and then the whales got harder to find. But right along that time, they discovered oil in Pennsylvania, mass production of oil. So oil substituted for, petroleum substituted for whale oil. So there have been a number of transitions like this, but of course, as you say, the world was much smaller then, and resources were much more available in relation to population. Right now, we have population's the highest it's ever been. What are we, 6 to 7 billion people in the world now?
7.4.
7.4. So and the resources, all the irreproducible resources in the world are some of them have been used and some are still there, but obviously the available resources in relation to population are going down. Then the question you raise, I think, Chris, is what is the next sort of energy transition and how much will it cost? I mean, we're talking about driverless cars now, electric cars, solar heating. Happen to be up in New Hampshire right now, and there are a lot of these windmill generators on top of the hills here in New Hampshire where there's pretty good winds. What is the next transition? How much will it cost? I think that's the issue you're raising.
Well, absolutely. So, a lot of people say, well, wind has a very good energy return on energy invested, and so we're going to lean on wind. The most recent data we have for the world is 2014 from the BP Statistical Review. And in that year, I surprise a lot of people when I say, if you round to the nearest whole number, wind's contribution to man's total energy consumption in 2014 was what? And the answer is 0, because it was 0.46%, so we got to round down.
Less, yeah, right. I knew it wasn't much, but the question is, can it become more? Will the hills everywhere in the world, like the hills of New Hampshire, and some in California, be covered with windmills? And is that really a solution to our problem? If we're 0.46% now, can we get it up to 5 or 10%, and get some more from solar? That's the issue. I think I'm not so quick to jump on your train when you say it's pretty clear we're going to run out of everything in 20 or 30 years, because people have been saying that for a long time. In the 1970s, when we had the crisis, my next door neighbor, I was in North Carolina then, said, the world is running out of oil, and we just aren't going to have any more of it. And economists point out that oil is not so easy to find, so you're not going to invest a lot of resources in finding the oil you need 100 years from now, but you will do it for 20 or 30 years. And it seems like for most of my lifetime, which is 70-some years now, people have said we only have 20 or 30 years of oil left. But every 20 or 30 years go by, then we still had 20 or 30 years. So I think that we really have to kind of study history to keep us from thinking we're about to run out of everything.
Well, the issue for me is really it's a little more nuanced. It involves the energy return on energy invested, and you look at the tar sands. Yeah, there's theoretically a Saudi Arabia worth of oil up there. in terms of volume, but not in terms of energy content that gets delivered back, because you have to use so much energy to power wash the sand, in essence, and bake it off and take this bitumen and crack it and add hydrogen to it. And there's all this stuff, right? So when you're done, you find that Saudi Arabia, we put 1 unit of energy and probably got 200 units back. In Canada, we might put 1 unit in and get 5 units back. Totally different equation, because you and I and the economy runs on the surplus, not the amount, if I can parse it that way.
Right. And that the investors' returns are on the surplus too, not the amount.
Yeah, so that's sort of a world we live in. I'm just watching this transition, but it really comes down to this. I believe that if we have functioning capital markets and a functioning economy, much is possible. 2008 really surprised me, and here's why. The chart, if somebody said, Chris, you get one chart, I will just show you growth in U.S. GDP against growth in U.S. total credit markets. And of course, the credit markets were compounding at about 8.9% a year starting in the early 1980s, compared to half that for nominal GDP compounding. So credit markets were growing at twice the rate of income in this case, if we call GDP income. And I just say simply, that's unsustainable. It broke there, Richard, just for a second. In 2008, credit markets actually went backwards a tiny bit in terms of total volume, because mostly the shadow banking system reeled in its horns pretty quick. That alone imploded. That alone seemed to be enough to get the then Treasury Secretary and a number of key financial officials to say the whole system almost got taken down. And here's my conclusion. It's either compounding nicely at twice the rate of GDP or it's imploding. Is that an unfair way to look at it? That was my learning from it. It seemed to be it's either exponentially happy or deeply unhappy.
Well, what I would say first, just as to the facts, one of the things that the economic historians have come up with in more recent research is just what you say, the tremendous growth of financial markets compared to the GDP growth. I mean, there used to be a sort of relationship between them that seemed to be pretty close. But for the last 50 years or so, the financial markets have expanded at a much higher compound rate. What it means is that the world has taken on a huge amount of debt. And there have been all kinds of ways of people compounding debt at a much higher rate than economic growth. It does seem to me to be inherently a dangerous situation, because all this debt has to be, serviced. You have to pay the interest on it, and usually you have to pay it back at some point. And so if it's growing much faster than the economic base that is going to generate the income to pay it back, I think we are, making ourselves more vulnerable. It's true in the United States. It may be even more true in some of the places in Europe where the banks seem to be more highly levered. And in China, there's been a tremendous expansion of credit in China. I'm sort of surprised that China has done as well as it has. It's one of the, it's sort of the exception to the rule that hardly any country that has a, high rate of modern growth runs into trouble somewhere along the way. The Chinese seem to have had a high rate of growth for 30, 40 years now and haven't run into any major trouble along the way. If they do run into trouble, I think it'll probably be related to the huge expansion of debt there, running into, financial problems.
Well, so in your research for the book on history of interest rates, did you come across anything that would either confirm or refute what Reinhardt and Rogoff came up with, which was A, that countries with high levels of debt experienced low levels of growth thereafter, and B, that sometimes high levels of debt led to other political, if not geopolitical / war kind of trouble?
Well, I think they're pretty much right about that. I mean, we as you mentioned, we had a high level of growth of debt in the United States leading up to the financial crisis. The crisis happened, and since that time, our rate of growth has been, really low compared to previous recoveries from either economic or financial setbacks, recessions or financial crises. This is the lowest in my lifetime. I think the rate of expansion since the previous crisis is, 2% or less, and generally in U.S. history, the economy snapped back earlier. Reinhardt and Rogoff said you have a period of slower growth after a financial crisis as compared with just an economic recession. We seem to be having that now, and of course, if we're a slow rate of growth now and we have another crisis, then maybe the rate of growth will be even slower. So I one of the puzzles, I guess, or it's a forecast by my fellow economist Robert Gordon, he claims that, we can just look forward to a much lower rate of growth in the future than we've had in the past. And furthermore, the ordinary people, the ones who are sort of angry populists now, they're the ones who are not going to experience much growth at all. So what growth we do have is going to generally flow to the top of the income distribution, and where the world may be becoming more unequal. It's kind of a gloomy outlook, and I haven't taken a position on it myself, but it's something we really have to study. That Donald Trump claims he's going to get us back up to 3 to 4% growth, and a lot of people seem to be pretty pessimistic about that. I'm just, I haven't taken a position yet, but I want to see what happens. It could be that with better economic policies, we could grow a little faster, but Bob Gordon says we don't have the great technologies of the past that fueled growth with us anymore. So we should look forward to slower growth.
Yeah, I've been on Facebook a lot. It doesn't help me do anything productive, so I can't say it's an awesome technology. But in closing, so let's imagine you have 10 $1 bills. You get to place them on red or black. Red is no more financial crises in our lifetime. Black is, hey, we might have another financial crisis in our lifetime. This is sort of harping off of course, what Janet Yellen very famously recently said. Where would you put your money? Red, no crises, black, a crisis, possibly.
Well, can I split my money?
You can. These are 10 individual dollar bills.
I guess what I would say, since financial crises seem to happen throughout history with some regularity, I would put maybe 7 or 8 on red if that's financial crisis in our lifetime, and maybe 2 or 3 on black, no financial crisis. I mean, we did have a long period from the 1930s to 2007-8 when we didn't really have a financial crisis in the U.S., so it's possible we could go for a time without that. But I think history would say it's more likely that we will have a financial crisis, and a lot of what we talked about today says it may not be that far off.
All right. Well, I have to ask, as a friend and colleague of Hyman Minsky's, if you could put words in his mouth, where do you think he'd place his money?
Oh, I think he would put probably 9 or 10 on what the financial crisis is coming, and he would say he would feel good about that right now, because he would say most people now think we're in a very stable time where the stock market's gone up for 10 years and interest rates are low. Most people are very complacent, and that's the stability that he said breeds instability. And so I think he would put most of his money on the financial crisis, not too far off in the future.
All right. Well, fantastic. Thank you so much for that. Thank you so much for your time today. This has really been fascinating. I could keep going, but we're out of time. So where can people follow your excellent work, and what's next for you?
Well, I put out a sort of popular biography of Alexander Hamilton. He's one of my specialties, to take advantage of all the interest in Hamilton that came out late last year. That's my most recent book. But I want to do a little bit more serious book on Hamilton's financial policies. He set up our financial system. He got the economic growth ball rolling in U.S. history. And I think people ought to know a little more about that. But, they can go to Amazon and look at my various books and watch for the next Hamilton book that'll be coming along in a year or two.
Well, fantastic. I have a personal interest in this. My great-grandmother, Mary Hamlin Parmalee, wrote one of the first plays that went on Broadway about Hamilton, that went back turn of the last century. Early effort for a woman of that era. She was quite the ticket. So that
I
was.
I think I've seen some reference to that. It wasn't quite as popular as the latest Hamilton.
No, but did okay. It had a run. It was on Broadway, so she was an amazing character. But that certainly sparks my interest in that. So we'll look for that book. Thank you very much for your time again, and this has been fascinating.
I've enjoyed it, Chris.